afternoon and welcome to the March version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. If you have any questions during our presentation today, please write them in the chat and we'll ask them to Chris if they are timely. Otherwise, we will get back to you directly or address it in our next MSOM. This month's edition is titled March Madness, where Chris will walk us through the latest market updates. We'll go across the pond to Japan and wrap it up with active investing. Take it away, Chris.
Thanks, Adam. Hello, everybody, and thanks again for joining us. Another fantastic month for equities. In February, we saw the U.S. advance 6.2%, which largely outpaced our counterpart here in Canada. Another sign of that economic divergence as well as market divergence. Inflation is beginning to come under control. We saw month over month, however, an increase in PCE inflation was matched expectations. A lot of that was coming from shelter, which was 2/3 of the price increase. Markets have forecasted now no rate cut in March and pushed that out to the June meeting. Our expectations are if we don't see a move in June, it's potentially not going to happen before the election, just because as you get into like the meeting calendar, it could be seen as a politicized move by the central bank and Jerome Powell if they do that type of a move that close to the November U.S. presidential elections. And if that's the case, you would likely see those rate cuts come off the table, and that could have impacts on both the U.S. dollar as well as the stock market, and something that we're watching extremely closely. Market expectations really did come in after the CPI report, as you know, inflation is still above trend, and the Fed has a single mandate or a dual mandate of unemployment as well as inflation, and unemployment is still doing quite well. You're seeing a very, very low level of unemployment in the United States and job growth that continues to march higher, a number that we'll be watching very closely on Friday to see if we see another big jobs print in the United States, which could again push those rate hike expectations out even further. We did see a small drop in January. However, that was driven mostly by part-time participation. Meanwhile, here in Canada, we have seen finally unemployment or inflation dip below the Central Bank of Canada's 3% measure. That does give the Bank of Canada a bit of firepower should they want to cut rates. But they did hold them consistent in March, driven by, again, stronger economic data here in Canada. I kind of jumped the gun and talked about performance a little bit early, but you can see here the S&P 500 was up 5.3% last month, 1.8% in Canada, not a shabby month, but obviously a large divergence between our two main indices. Bitcoin led the charge higher by 44.7% in February, ahead of the April halving, which is taking place on strong fund flow data from ETFs that recently launched in the United States. That continues to move higher, something we're watching closely, but we are concerned that it is a buy the rumor, sell the news event leading up to that halving in April, and we are considering taking some profits on our position that we hold across client accounts here at Team LWC. The 10-year yield has remained stable inside of like a 4.1 to 4.4 range. We have added a bit of duration to our portfolios. Our expectations are that bond yields move lower. That will be good for longer duration assets, including bonds, as well as some of the Canadian bond-like proxies, telcos, REITs, utilities that have really struggled here of late. What we're showing on the chart on the right is that deficits spending has been on an extreme rise since the pandemic in 2020, which has been fueling a lot of this rally. And we just got through earnings season in the United States. 73% of companies surprised to the upside. That is a little lower than the average that we've seen lately, but still encouraging results. And we think that this market rally has been pretty strong. We are a little cautious, wouldn't be overly surprised to see a short-term weakness, but we're generally quite bullish with equities and with bonds, and it's a great time to be invested and to stay long while not trying to chase too much of the hype and continuing with an active allocation approach. One of the only markets to do better than the United States has been Japan. Their Nikkei index is the top performer again so far this year. We added a position there early last year. It's done quite well. It's one of our thematic bets. We like Japan. It's a very shareholder-friendly G8 nation, huge share buyback programs, large dividends, good corporate governance, and now hitting a 34-year high on the back of those growing corporate profits. Some investors are concerned with the yen. It has depreciated to the 150 level. We see a technical ceiling at that point. We discussed the possibility of hedging that risk at our recent investment committee meeting, decided against it and think that there is upside strength for the yen. The risk is that rate cuts get off the table in the United States and the dollar remains strong. But that is our position at the moment, is long the Japanese economy while eliminating any kind of hedging of the currency. It does bring a unique diversification aspect to our portfolios. You can see the correlation with North American markets is quite low between the Japanese market and the S&P 500 and the TSX. And that provides us, again, even more diversification from this Magnificent Seven rally. Now it's kind of turning into the Magnificent Five or Four as you eliminate Tesla and Apple kind of diverging to the downside across those two, or across that cohort of high moving tech stocks. One of the other things we've been doing lately is getting more active, not physically. We try to stay active all year round, but with our portfolios, we have been adding active management. We've seen a divergence as of late, randomly. Kind of January was the largest outperformance by active managers since 2007. It has paid to been passive. You can see that in our Mind the Gap chart. Essentially, active managers just underperforming the broader indices over time, but that has been narrowing. One of the areas where this is prominent is in Japan. Japan actually, it's had one of the highest dispersions in quite some time, and we're also seeing these dispersions across credit here in North America, with differences in issuers and maturities, and then also across sectors. And so it's something that we think paying for active management at this time is worth it. I could just highlight a couple of the active managers that we own in the Team LWC portfolios. Noah Blackstein with the Dynamic Power American Growth had a double-digit return month last month in February against a 5.5% return for the benchmark. And Mark Schmel with the Global Innovators Fund at Fidelity, I think, put up 13.5 or 14% in February. So paying 1% and change for those guys to help us with those more esoteric, technologically specific investment ideas has been worth it. And then the last point we wanted to talk about here on the behavioral finance side is a bias called overconfidence bias. A lot of people attribute their one success or one situation to skill versus luck, when in a lot of cases that could have just been, the coin flip landed on heads. You thought it would be heads, and now you think you're a really good coin flipper. So that can lead to dramatically poor returns. This is another example of that minding the gap situation, where most investors have not received the annualized returns of the mutual funds they're investing in, because they typically get into them when they're working and they get out of them when they're not. And so this is just another example of some of the biases that impact all of us as investors. The two best ways to overcome your behavioral biases is, one, to be aware of them, and two, to work with an advisor or a trusted support system that can help you, discuss those opportunities. I just got off a call doing something of just the same. And it's just, good to take your time, sleep on it. It's a very emotional endeavor investing. And so, being aware of these biases, and it's something that we'll touch on as we work through our Making Sense of the Market series.